Have you ever wondered what's really behind the fluctuating prices at the pump? Or, how events happening way across the globe can actually hit your everyday life. Today, we're doing a deep dive into the fascinating and, let's be honest, often volatile world of oil and gas geopolitics. It's a huge story of power, economics, and some really surprising connections that touch pretty much everyone everywhere.
Absolutely. And our mission for this deep dive is really to give you a clear, informed perspective. We've compiled a whole stack of recent reports, lots of deep research, everything from detailed analyses of past market crashes, like the one we'll talk about, to forward-looking forecasts for 2025. We've even got warnings about cyber threats in there. So, yeah, we're here to pull out the most important nuggets of knowledge, those key insights, to help you understand why oil and gas are still so crucial on the global stage, even with a shift towards renewables.
Okay, so let's unpack this. A good place to start is that really wild moment back in 2020, the Russia-Saudi Arabia oil price war. You have to remember, early 2020, COVID-19 was just starting to hit hard, factory output, transportation demand. It was all going way down. Oil prices had already fallen, about 30% by then?
That's right. And on top of that, you had U.S. shale production, which had been ramping up its market share since around 2014, and OPEC, plus that's the OPEC members, plus others like Russia, formed back in 2016 to manage prices. They'd already cut production by 2.1 million barrels a day. So the market was already tense.
Right. That existing backdrop really set the stage for the breakdown, didn't it?
It did. So March 5th, 2020, there's an OPEC Plus meeting. OPEC proposes cutting production even further to prop up prices. But then March 6th, Russia famously rejects it, just says no.
And boom, oil prices fall another 10% almost immediately. That rejection basically marked the end of their informal partnership, right?
Pretty much. And Saudi Arabia's response was, well, swift and dramatic.
Oh, yeah. March 8th, they just announced these unexpected massive price discounts, like $8, $6 a barrel slashed off their prices.
The market reaction was instant and brutal. Brent crude, the international benchmark, fell 30%.
30%. That was the largest single drop since the Gulf War.
Exactly. And West Texas Intermediate, WTI, the main U.S. benchmark, that fell 20%.
And it wasn't just oil. Global stock markets went into a nosedive. It was dubbed Black Monday.
Yeah, the Dow Jones fell over 2,000 points. The S&P 500 dropped 7.6%. NASDAQ 7.2%. Huge drops.
And the Russian ruble took a big hit, too, falling 7% to a four-year low.
While the immediate trigger was definitely the pandemic hitting demand, plus this production spat.
Right.
What the whole situation really did was highlight these deep vulnerabilities in the system.
Right.
It wasn't just a temporary market blip. It really exposed how interconnected and, frankly, fragile global supply chains are.
But the story of 2020 gets even weirder. Here's where it gets really interesting. April 20th, 2020. The price of WTI oil, specifically for May delivery, it actually fell into negative territory.
Negative $37 a barrel. It's still unbelievable.
Right. For the first time ever recorded, just imagine that people were literally being paid to take oil off someone's hands.
Because demand had just cratered,
Yeah.
and there was nowhere to put the oil. Storage was filling up incredibly fast.
Especially at Cushing, Oklahoma, that key storage hub. It hit something like 81% of its working capacity, which is about 76 million barrels.
Yeah, and some Canadian oil, I remember, even fell to $0 a barrel. Just absolutely nuts.
So the ripple effects from all this were obviously huge and widespread.
Oh, definitely. Saudi Aramco had to cut back its capital spending. Russia, which had planned for a budget surplus, suddenly faced a deficit. And the ruble, it dropped over 30% between January and March that year.
And what about the U.S. shale producers? They got hit hard too, didn't they?
Massively. They generally need prices above, say, $40 a barrel just to keep going. So with prices crashing, you saw huge cuts in new drilling. And major bankruptcies started rolling in companies like Whiting Petroleum, Diamond Offshore Drilling.
It wasn't just the big players either. Currencies felt it too. The Norwegian krone hit historic lows. Nigeria had to devalue the naira.
Yeah, the key insight from 2020 isn't just about the market chaos itself. It's how a sort of localized production fight, amplified by a global crisis, could expose these fundamental cracks in the entire global economic system.
And speaking of that chaos, there's this intriguing legal battle still going on, isn't there? Kind of sheds light on how some might have, tried to profit from it.
Ah, yes, the Vega Capital London case. It involves, 9 independent traders?
That's the one. They're accused of market manipulation. Allegedly, they coordinated trades to artificially push prices down even further on that crazy day, April 20th.
And supposedly made something like $660 million. in just a few hours.
Wild. And that trial is expected to run until at least 2025, so we might hear more about that. Okay, so let's fast forward from that chaos to today, 2025. What's the current outlook? Our sources suggest maybe another wild ride ahead.
Well, a lot of the current unease centers on the rising tensions between Israel and Iran. That's a huge factor.
Because of the Strait of Hormuz, right? That critical choke point.
Exactly. Somewhere between 20, maybe 25% of the entire world's oil supply flows through there. So any disruption, any closure could, as one source put it, send prices skyrocketing to many hundreds of dollars a barrel.
Wow. Many hundreds. That sounds like it could trigger.
Well, the source mentioned hyperinflation and possibly a worldwide depression. That's serious.
It is. And it's not just geopolitics creating uncertainty. We also have natural disasters adding another layer.
Like Hurricane Milton recently, impacting the U.S. Gulf Coast.
Precisely. That disrupted fuel supplies all across Florida. You had over 3.4 million homes and businesses lose power. A quarter of gas stations reported outages.
And gasoline futures jumped pretty sharply because of that, didn't they?
Yeah, 4.1%. It just shows how quickly a single event, even a regional one, can ripple through energy prices and availability.
So it sounds like there's a lot of potential instability floating around. What about OPEC plus PAC? Can they step in? Do they have the capacity to cushion these kinds of shocks? That's the big question. They do have some spare production capacity, on paper, around 5.86 million barrels per day, mostly held by Saudi Arabia and the UAE.
Okay, so that sounds like a decent buffer.
It could be, but our sources describe it as a double-edged sword.
How so?
Well, think about it. If the conflict in the Middle East spreads, the very countries holding that spare capacity could be affected. It might compromise their ability to actually bring that oil online, or they might become unwilling to use it for geopolitical reasons.
I see. So the cushion might disappear just when you need it most.
Exactly. So, while the overall price forecast might look somewhat modest on average, it's the volatility, the potential for these sudden, sharp spikes driven by unpredictable events that's the real worry for markets and economies.
So we're basically bracing for a potential roller coaster. What are the actual price predictions looking like amidst all this potential chaos?
Well, the forecasts vary, as you'd expect. Oxford Economics, for instance. They think if a major disruption does happen, prices could average $115 a barrel in the third quarter of 2025.
$115. But then they expect it to fall back.
Yeah, back towards $75 by the middle of next year, assuming things calm down.
Okay. What about other forecasts?
Goldman Sachs Research has a slightly different view. They see Brent trading mostly in the $70 to $85 range in 2025, averaging around $76. But they add the caveat, there's potential for temporary spikes, maybe into the mid-80s or even close to $90, especially if Iranian oil supply drops.
Which could happen due to tighter sanctions or, say, stronger U.S. support for Israel affecting Iran's exports.
Precisely. And then you have the demand side. China and India are absolutely pivotal players there.
China relies heavily on Iranian oil, doesn't it?
It does. So if those exports dry up, China would have to find alternative suppliers, which would tighten the market even further.
And India.
India's crude imports were recently up 6.4%. Higher prices really strain their economy. It weakens the rupee. One source suggested it could breach 84 against the dollar and widens their trade deficit.
So these big demand centers are really feeling the pinch from this volatility.
Immediately. They're
Yeah.
very exposed.
And, the impact of these oil prices, it goes way beyond just what you pay at the pump, doesn't it? It sends ripples everywhere.
Oh, absolutely. It creates these cascading effects throughout the entire global economy.
Take transportation costs. Our sources say a $10 increase per barrel raises global transport costs by about 1.5%.
Right. And that hits container shipping rates, it hits airlines. Aviation fuel is like 20–30% of their operating costs. And trucking expenses for basically everything that moves.
Agriculture, too, hugely dependent on petroleum for machinery fuel, fertilizer production.
Which often uses natural gas, and natural gas prices are frequently linked to oil prices.
Right. And transporting the food products themselves. A big oil price hike could raise food production costs by, 15 to 30%?
Easily. And manufacturing faces a double whammy. Higher direct energy costs, plus increased costs for raw materials like plastics and chemicals derived from petroleum.
So this cascading effect really underlines something critical, doesn't it?
It does. Oil isn't just another commodity. It's like the invisible lubricant for almost every part of the economy.
Its price isn't just a number. It's a leading indicator for inflation, for supply chain health, even for national budgets worldwide.
And what's also fascinating here is how these geopolitical tensions create these complex war economy dynamics.
Meaning,
Well, you see increased government spending on defense and foreign aid. Like, the U.S. defense budget went up by roughly $100 billion in 2024, largely due to Middle East tensions alone.
wow.
And it creates these really difficult dilemmas for central banks. They're trying to fight inflation driven by energy prices, but they also don't want to slam the brakes on the economy and cause a slowdown. It's a tough balancing act.
Beyond those direct economic impacts, there's this really interesting connection to assets like gold. You mentioned this briefly. It seems when oil gets volatile, especially during Middle East conflicts, gold often reacts in a, well, fairly predictable way.
That's right. They often move in tandem during those periods. Gold typically rallies. People see it as a safe haven asset, a hedge against inflation.
And the data backs that up.
Yeah, historical data suggests that for every 10% jump in oil prices during conflict times, gold tends to rise somewhere between 2% and 5%.
What drives that? Is it just fear?
It's partly the fear trade, definitely, investors seeking safety during geopolitical uncertainty, but it's also combined with what some call money printing to fund military operations.
Ah, so increased government spending, potentially financed in ways that devalue currency.
Exactly. That combination creates pretty powerful upward pressure on gold prices.
And what about silver? Does it follow gold?
Silver's in a unique spot because it has this dual nature. It's a precious metal like gold, but it's also a crucial industrial commodity.
So it gets pulled in different directions during an oil crisis.
Right. Higher energy costs might slow down industrial activity, which could reduce demand for silver. But at the same time, investment demand often rises as people seek inflation protection. And crucially, demand for military applications can also increase.
Which makes its price movements more jumpy.
Generally, yes. Often 1.5 to 2 times more volatile than gold swings during these periods because of those competing pressures.
And you mentioned military applications. There's this often overlooked factor, the direct military consumption of these metals.
Yes, and some of the details are quite striking. One source pointed out that each Tomahawk missile contains about 500 ounces of silver.
500 ounces in one missile. For electronic components, I assume?
Primarily, yes. And defense industry analysts estimate that during active conflicts, these military uses can account for 5 to 10% of all industrial silver demand.
So these conflicts aren't just driving up energy prices, they're creating direct demand for key materials used in defense tech. It's a whole feedback loop.
Exactly, a complex interplay.
Okay, so we've got physical supply threats, geopolitical maneuvering. As if that weren't enough, our sources are highlighting a growing digital vulnerability for oil and gas infrastructure.
That's right. There was a stark warning issued just recently, May 8th, 2025. It came from CISA, that's the Cybersecurity and Infrastructure Security Agency, working with the FBI, the EPA, and the Department of Energy.
And what was the specific warning about?
They warned about cyberattacks specifically targeting the operational technology, the OT, and the industrial control systems, or ICS.
Okay, OT and ICS. Just to clarify, those are the systems that actually control the physical processes, right? Like opening valves on a pipeline, controlling refinery operations.
Precisely. The specialized computer systems and networks that manage the physical world in critical infrastructure, not just the office IT networks.
And what did CISA recommend organizations do?
The recommendations were pretty straightforward, but absolutely critical. Things like disconnect your OT systems from the public internet wherever possible. Use stronger, unique passwords. Secure any remote access to OT networks very carefully. And segment your OT networks from your IT networks. Basic hygiene, but crucial.
It sounds basic, but experts are saying even alerts about unsophisticated attacks are noteworthy now.
Yes, because it indicates that maybe even the basics aren't being done consistently across the board. And experts also point out that AI is, and I quote, enabling less sophisticated threat actors to operate in a more sophisticated fashion.
So AI is lowering the bar for causing serious disruption?
Potentially, yes. And critical infrastructure has long been seen as a top target for cyber attacks, both by nation-states and criminal groups.
And these aren't just random attacks, are they? There's a strategic element.
Increasingly so. We're seeing what sources call a substantial global increase in sophisticated threat actors targeting C&I critical national infrastructure. Often, they're not just looking for a quick hit. They're building strategic pathways to yield geopolitical leverage in the event of conflict. They're embedding themselves, waiting.
That's chilling. And the way IT and OT systems are becoming more connected makes this worse.
It definitely expands the attack surface.
Hmm.
Traditional security measures, often designed just for IT, aren't always sufficient for these converged environments.
So it's not just about protecting data anymore. It's about preventing someone from digitally hijacking the physical controls of our energy supply.
That's the core concern. The digital front line is becoming just as critical as the physical one for energy security.
Okay, let's pull back and look at the longer view. Beyond the immediate crises, there's this massive force reshaping the whole landscape, the energy transition.
Absolutely. And it's already changing the geopolitical importance of oil.
How so?
Well, think about the U.S. shale revolution combined with the global push towards renewables. Our sources suggest this has already reduced the strategic weight of the big OPEC exporters in the Persian Gulf, at least in the eyes of U.S. politicians.
That's a big shift from, say, the Carter administration onwards when Gulf oil was paramount to U.S. foreign policy.
A very big shift. Plus, many other countries are now significant crude oil suppliers, further diluting the strategic importance of just those key OPEC members for importers like the U.S.
But the transition isn't making all the old problems disappear, is it? One source outlined what they called the 10 biggest geopolitical challenges related to oil and gas that still persist.
That's a great point. The transition creates its own challenges and doesn't erase all the old ones overnight. For instance, the geographical concentration of reserves,
Right. So much oil and gas is still concentrated in a few places like Saudi Arabia, the UAE, Iran.
which gives them disproportionate power and leaves major importers think Europe, China, Japan, strategically dependent and vulnerable. That hasn't gone away.
And the use of energy as a diplomatic weapon, that's still happening too.
Definitely. We saw Russia cut off gas supplies to several European countries after invading Ukraine in 2022. Iran frequently threatens to close the Strait of Hormuz. That leverage persists.
Then there's the inherent instability in some producing countries, Libya, Venezuela, Nigeria, Iraq.
Which can cause sudden supply disruptions completely unrelated to broader geopolitics.
Yeah.
Just internal chaos spilling over.
And oil still fuels conflict, doesn't it? Financing rebel groups, justifying interventions.
Sadly, yes. And economic sanctions on producers like Iran, Russia, Venezuela, while intended to pressure them, also push them to find new trading partners, which contributes to fragmenting the global energy market, not necessarily making it more stable.
And some producers are actively resisting the transition, aren't they? Pushing alternatives that critics say just prolong fossil fuel use.
Yes, that resistance to the energy transition is another challenge, promoting things like blue hydrogen or large-scale carbon capture, which are controversial.
And the transition itself creates new competitions, like for lithium, cobalt, rare earths needed for batteries and renewables.
Exactly. That's a huge emerging challenge. China currently dominates the processing of many of these materials, creating whole new tensions, especially with the U.S. and Europe.
And finally, the source mentioned the socio-environmental costs, pollution, deforestation leading to more local opposition and pushback from NGOs.
Right. So if we connect this to the bigger picture, the energy transition isn't just about cleaner energy. It's fundamentally redrawing the global power map.
But it's complex. It solves some old problems while creating new ones.
Precisely. And what's really fascinating is the idea, highlighted in one report, that even with major disruptions, like when Russian fossil fuel supplies were heavily sanctioned in February 2022, global energy prices remained relatively under control. And the argument is that the ongoing energy transition itself acted as a kind of long-term shock absorber. There were alternatives, there was efficiency, there was a sense the future wasn't solely fossil fuel dependent.
That's an interesting take. The transition providing some underlying stability even amidst chaos.
But it's crucial to understand, as those challenges highlight, that unwinding a century-old global energy system is incredibly complex. It's not like flipping a switch. It's slow, it's difficult, and it creates new geopolitical hotspots even as it resolves old ones.
And despite this transition, oil demand isn't vanishing tomorrow, is it?
Not according to Goldman Sachs, anyway.
Yeah.
Their forecast suggests global oil demand will likely keep growing for another decade.
Driven mostly by emerging markets.
Primarily, yes. Emerging economies growing at nearly 4% a year. Plus, some sectors are just really hard to decarbonize quickly, like air travel, petrochemicals for plastics, and other materials.
Even while electric vehicles are starting to eat into road fuel demand.
Right. EVs are expected to slow global oil demand growth by nearly 0.6 million barrels a day by 2026, according to that forecast. But growth from other areas is expected to offset that for a while yet.
So, bringing this all together, what does this complex picture mean for you, listening right now?
Well, I think it means really understanding this deep interconnectedness. how a conflict far away or a cyber attack on a pipeline you've never heard of can directly influence your life, your wallet, the economy you live in.
So the key takeaways from our deep dive today seem to be ongoing volatility is kind of the name of the game in oil markets.
Definitely. And the geopolitical landscape around energy is constantly shifting, evolving. New threats, like sophisticated cyber attacks on critical infrastructure, are emerging and growing.
And the energy transition, while happening, is this long-term, definitely not straightforward and challenging process. It's fundamentally reshaping global power, but not without creating its own set of problems.
Exactly. It's nonlinear, full of friction.
You know, as we think about these shifting sands, maybe the biggest question for the future isn't just where our energy comes from anymore. Perhaps it's becoming more about who controls the information and the infrastructure that delivers that energy, whether it's oil, gas, or electrons, and how prepared we really are for the unexpected bumps in this global transition.
That's a powerful thought to end on. The control aspect is becoming increasingly central.
We really encourage you to continue your own deep dive into these topics. Maybe explore the rise of green energy infrastructure and the whole new set of geopolitical challenges that come with securing those critical raw materials we touched on. There's a lot more digging to do.